Same thing for Google. Literally at the low end of the range. See that, Freebird?
Yeah, I did. And I will say quickly, our plans for this morning fell through. So I do have a little guest this morning to talk Google with me. So all the signs of slowing are there. Yes, Q2 was not as bad as feared, but where we are in the cycle for Google, I think is right where Meta was last year in terms of the specific fundamental factors related to cost per click and return on ad spend. And also when we think about Google versus Meta, remember, Google still has more exposure to the real economy, things like travel. Meta is still more exposed to native e-com, where search has, like I said, more exposure to the real economy. So in that sense, I don't think that this is a positive read for Meta. And it's not even a positive read for Google, right? Because we know where this is headed. The cycle is going to take them, continue to take them down and down and down and down. And so when we start to see marginal demand for ad spend decline, right? When we start to see the first crack, the first thing to get cut on the margin are the low return on ad spend channels like social, programmatic display, like the Trade Desk, experimental budgets, things like CTV, brand advertising, Twitter. That's what gets cut first. Search gets cut last. So the fact that we're at this part in the cycle where things are starting to turn negatively and we're still only seeing marginal weakness or modest weakness in Google, that makes sense to me. But the point here is that while everyone else is going to be putting up atrocious results like we saw with Snapchat, and I think we're going to see with Meta this evening and other smaller names in the digital advertising space as earnings season progresses, Google's fundamentals are going to slowly start to crack. I think the move here is you fade Google on any strength or you short it. And then if Meta is up on this, which it looks like it is, I think you just probabilities are in your favor. You have to take the shot on the short side with Meta into the print.
Something goes to the low end of the range and develops an implied volatility premium. What do? You don't get mad at me. You don't get triggered. You don't short and hold. You cover to your minimum if you can. And if you just want to short and hold, you're going to learn these lessons the hard way. There's a reason why there are not a bunch of world-class short sellers printing alpha across decades of returns. Today's a great day to learn. Microsoft coming in, look at it. I mean, it had a 21% implied vol premium going into the print with the stock at the low end of the range. That's A/B tested. There it is. Google wasn't as obvious on the implied vol piece. And again, the flow through to the other stocks is a great point, whether it be Tesla or Net. I mean, we're going to short all of them because we have been short all of them. And we're going to send out signals. So again, I'm going to have the patience embedded in the process to pick the one that is so fortunate to deliver us the top end of the range when that happens.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.